Macroeconomic Update, February 2020. The month of February was a challenging month for the capital markets, with equities correcting across all major markets on rising concerns due to coronavirus spreading to over 60 countries, including Korea, Japan, Italy, and the US. The new cases reported in China have been falling, but the rise in cases outside China has led to worries about potential impact on global growth. India has been relatively insulated till now, with only 5 cases recorded till March 2, 2020, of which 3 have recovered, but the risk of infection spreading remains. During the month, the number of cases infected by coronavirus rose to around 87,000 from around 12,000 a month ago. Currently, a bulk of cases, around 90%, remains concentrated in China, especially in Hubei province. However, the number of new cases reported from South Korea, Japan, Italy, United States, etc. have jumped, raising the level of concerns. Global commodity prices have also corrected on back of concerns over global growth, especially China. The situation is still evolving, and it is difficult to assess the potential economic impact on the global economy with certainty. If the spread of the virus is contained within a reasonable time, impact on growth is likely to be short-term, and it should recover over the next couple of quarters. However, to counter the slowdown, stimulative measures are likely by major global central banks, along with expansionary fiscal policy by few countries. This combination of weak near-term growth, easing liquidity, and low commodity prices bodes well for global rates and inflation, which may thus remain lower for an extended period. Impact on India's growth is likely to be limited in our view, unless the containment of coronavirus is delayed significantly. Further, the expected easing global liquidity and fall in the US yields may lead to lower yields in India as well. Additionally, over the medium to long term, many global MNCs are likely to consider diversifying their manufacturing operations from China, and India could be a likely beneficiary given the low corporate tax rate, skilled population, relatively low wages, and a large domestic market. For more on this, please refer to HDFC MF Yearbook 2020, published on our website in January 2020. India's growth softened, with Q3 FY20 GDP growth moderating to 4.7% year-on-year from 5.1% in Q2 FY20. Contraction in investments dragged down growth. Private consumption improved marginally, while government consumption held up well. Weak industry growth, especially contraction in manufacturing segment, resulted in growth in gross value added slowing to 4.5% year-on-year. Growth in services has held up well. Contraction in manufacturing could be because of inventory correction, especially in auto, and can bounce back as restocking resumes. After rising 273 basis points in the past 2 months, Consumer Price Index (CPI) increased further to 7.59% year-on-year in January 2020, up 24 basis points month-on-month. The rise in CPI was due to elevated food inflation, which rose by 11.8% year-on-year, slightly lower than last month. Vegetable prices, especially onions, have corrected in February 2020 and should have a moderating impact on CPI going forward. Fuel inflation inched up, mainly due to base effect. The core CPI was within comfortable range and has remained below 4% for the past 4 months now. Wholesale Price Index also rose to 3.1% in January 2020 from 2.6% a month ago, driven by high fuel inflation and elevated food articles inflation. Fuel inflation increased to 3.4% year-on-year from -1.5% a month ago. Food articles inflation stood at 11.5% year-on-year for January 2020, slightly lower than 13.2% a month ago. Inflation of manufactured products inched up slightly to 0.3% year-on-year. Industrial production (IIP) for the month of December 2019 turned negative at -0.3% after turning positive a month ago. Mining grew by 5.4%, while manufacturing contracted by -1.2%. By usage, the intermediate and primary goods grew by 12.5% and 2.2% respectively, while capital goods, consumer durables, and consumer non-durables contracted by -18.2%, -6.7%, and -3.7% respectively. The core industries registered increase of 2.2% in January 2020 on back of healthy growth in coal, cement, and electricity. The fertilizers production growth fell to -0.1%, while natural gas and crude production declined by 9.1% and 5.2% respectively. While the monthly numbers are relatively volatile, on a 3-month moving average basis, electricity and cement production are showing sign of uptick, pointing at some revival in economic activities. Growth in electricity generation through conventional sources has improved to around 7% in February 2020. India's trade deficit for January 2020 increased to $15.2 billion, up approximately $3.9 billion, primarily on account of increase in net imports of oil. Net gold imports fell sharply during the month on back of lower volumes. Excluding oil and gold, the trade deficit increased due to higher imports of electronics and engineering goods. INR depreciated approximately 1% against USD and closed at 72.2. With disruption in supply due to coronavirus, fall in oil prices by approximately $15 per barrel over 2 months, and decline in gold volumes, trade deficit is likely to fall in Q4 FY20. This may result in India's current account deficit improving considerably in Q4 FY20. Fiscal deficit for FYTD January 2020 stood at approximately 129% of FY20 revised estimates, higher than approximately 122% during the same period last year. Gross tax revenues fell by 2%, with direct tax collections degrowing at 4.9% and indirect tax collections growing by approximately 1%. This was partially set off by higher dividend payout by RBI. Growth in expenditure remained healthy at 13.3% year-on-year, resulting in fiscal deficit widening to 4.8% of GDP in FYTD January 2020, as against revised target of 3.8%. Most commodity prices softened, driven by concern over global growth as coronavirus spread in 53 countries, including US. China's economic activity continues to remain weak, with restart after the new year being delayed. During the month, Brent crude prices fell by approximately 13% and closed at $51 per barrel. Debt market update, February 2020. The 10-year benchmark G-Sec yield ended the month of February 2020 at 6.37%, down 23 basis points over the previous month end. Average interbank liquidity continued to remain in surplus for the month due to high central government spending, forex purchases by RBI, and soft credit growth vis-à-vis deposit growth. Corporate credit spreads over G-Sec yields fell by 12 basis points during the month. Outlook. The minutes of the 6th bi-monthly meeting of the Monetary Policy Committee held in February 2020 were largely in line with expectations and hinted that any further rate cut is likely to be data-dependent. Members noted uncertainty on inflation trajectory and some sign of pickup in economic activities. With the concerns over growth due to spread of coronavirus, outlook on yields has turned favorable in our view. This is on account of multiple factors, that is, Global growth might soften with supply chain disruption expected in China. Global central banks, including RBI, are likely to push for stimulative measures and ensure adequate liquidity. And commodity prices have corrected significantly, which bodes well for lower global inflation. While in the medium term, growth should recover, but the impact of stimulative measures might persist for longer. India is likely to be a beneficiary as the debt flows to emerging markets are likely to improve. Apart from the aforesaid, factors such as decline in US yields, ample liquidity, unconventional tools used by RBI to improve transmission of rate cuts, muted credit growth vis-à-vis deposit growth, fall in commodity prices, especially crude oil, etc., favor lower yields. This is partly set off by concern over fiscal slippage for FY21, excess statutory liquidity ratio investments within the banking system, high near-term headline inflation, possible bottoming out of growth, etc. On an overall basis, the factors favoring the lower yields now seem to outweigh factors supporting higher yields, especially at the shorter end, in our opinion. In line with global yields, G-Sec yields in India have also corrected partially. While there is still some room for yields to fall further, the scope seems limited as most of the factors are priced in to a certain extent. In view of the above, we continue to recommend investment in short to medium duration debt funds. Further, the prevailing high credit spreads also create a favorable risk-reward opportunity in select pockets, in our opinion. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.